Welcome back to the Deep Dive. It is Sunday, January 18th, 2026. If you've been watching the charts this week or maybe just doom scrolling the financial headlines, you might be feeling a little disoriented.
I think that's the right word.
We are looking at a stack of reports today. Heavy hitters like Grayscale, Bybit, Deloitte, and, the picture they paint is not what we were promised 5 years ago.
Yeah.
It suggests that the crypto roller coaster we all grew up with.
That predictable, violent boom and bust cycle.
That it isn't just changing tracks, it's arguably being dismantled entirely.
It really is. I mean, if you synthesize what Bybit and Grayscale are saying in their 2026 outlooks, the overarching theme is that the Wild West era is officially dead. We have entered the institutional era.
Oh, right.
And the headline here, the one that really matters, is that the famous 4-year cycle, the one everyone sets their watch by, might actually be broken.
So that's the premise we need to test today.
Yeah.
Because for the last decade, that 4-year cycle tied to the Bitcoin halving was basically, it was the laws of physics for this market.
You could practically set a calendar to it.
Exactly. But we have 3 massive shifts in these documents that argue those laws are being rewritten. First, we have market data suggesting macroeconomics has effectively eaten the halving.
And second, a geopolitical shock wave coming out of China that breaks every rule in the central banking handbook.
And then the third one is the quiet rise of agentic AI in finance.
Yeah.
We are not talking about ChatGPT anymore.
No, not at all. We're talking about autonomous agents that manage wealth and compliance without a human even in the loop.
It is a lot to cover.
Yeah.
But I want to start with the market structure, specifically the Bybit 2026 outlook and that Grayscale report. They were both making this bold claim that the cycle is fading. But what does that actually look like in the numbers?
Right.
Because the cycle is dead is something people say every cycle right before it crashes. Why is this time different?
That's a fair skepticism, but the data structure is fundamentally different this time. Historically, price formation in crypto was, it was mechanical.
Mechanical half.
Bitcoin halves, supply drops, price goes up, retail goes crazy, huge bubble, then it pops. Rinse and repeat. It was a retail-driven feedback loop.
Right.
Bybit and Grayscale are pointing out that in 2026, price formation is no longer mechanical, it is macroeconomic. It's driven almost entirely by Federal Reserve rates and institutional allocation models.
So we aren't waiting for a code update to move the price. We're waiting for Jerome Powell's successor to speak.
Effectively, yes. The market has grown up. And you can see it in the options markets. This is where it gets a little technical, but it's fascinating.
Okay.
Bybit's report highlights a specific implied probability. Right now, looking at the options chains, the market is pricing in only a 10.3% probability that Bitcoin hits $150,000 by the end of this year.
Wait, hold on. That seems incredibly low. I mean, we are in 2026. In previous cycles, during a bull run year, people would be pricing in 50-60% odds of a double up.
Right.
10% feels bearish. Is the market that pessimistic?
It feels bearish to a retail trader used to mania. But to an institution, it reflects a mature, efficient market. In a retail-driven mania, that probability swings wildly because it's based on emotion on FOMO. Here, it's calculated, it's based on hedging strategies. It tells us that the upside is being capped by rational actors selling calls, not fueled by, the guns buying leverage.
So it's not pessimism, it's precision.
That's a good way to put it.
And Grayscale points out another milestone that usually drives that mania. We are approaching the mining of the 20 millionth Bitcoin. That's expected around March of this year.
Right. Which leaves only 1 million coins left to be mined for the next 100 years or so. It's a huge psychological barrier.
Usually that scarcity narrative is enough to send the market into a frenzy. Running out of Bitcoin, get it while you can. But you're saying the market is just shrugging it off.
It's not shrugging it off, it's just pricing it differently.
Yeah.
Grayscale argues that scarcity isn't the primary driver of volatility anymore. The driver is the integration of crypto into traditional finance through ETFs and stablecoins. And this brings us to the concept of institutional stickiness that's mentioned in the XBTO report.
Stickiness, I like that term. What does it actually mean in this context?
Well, think about how retail trades. When the chart turns red, retail.
Panics, sells, the money leaves the ecosystem.
Exactly. Institutions generally don't do that. They hedge. The XBTO report notes that volatility has compressed significantly. We used to see 30-day realized volatility north of 50%. Now, it's sitting around 6.46%.
That is a staggering drop. That's tighter than some tech stocks.
Exactly. And why? Because institutions are selling options to generate income rather than dumping the underlying asset.
Mm.
When you sell options, you are essentially selling insurance to other people. That act dampens the waves. They're putting a wet blanket on the volatility to harvest yield.
So the roller coaster has better brakes now. But doesn't that also mean the up-only rocket ship is gone? If they are dampening volatility, they are dampening the upside too.
That is the trade-off. You get stability, you get integration, but you lose the 100x gains in a month. The era of the moon mission is being replaced by the era of the diversified portfolio.
Right.
You can see it's in the corporate adoption side, too. We used to talk about MicroStrategy all the time. Now the reports are calling it Strategy Inc., and there are over 200 public companies doing the exact same thing via digital asset treasuries or DATs.
The Pioneer Premium is gone.
Eroded completely. Back in the early 2020s, if a company put Bitcoin on its balance sheet, its stock price would skyrocket because it was novel. It was a proxy for Bitcoin.
Yeah.
Now, because everyone is doing it, you don't get a gold star just for showing up. You actually need an operational strategy. Investors are asking, okay, you hold Bitcoin, so what? How does that help your cash flow?
Okay, so the market side is looking stable, institutional, and frankly, a bit more boring than we're used to. It's maturing.
I think so.
But if you pivot to the geopolitical side, boring is the last word I'd use. This China news feels like a genuine aha moment in the research stack, and I don't think people realize how big this is.
Oh, it is the biggest story of 2026 so far, and honestly, the mainstream press is severely underplaying it because it's complicated, but the implications are massive.
Let's lay it out. January 1st, just a couple of weeks ago, China's digital yuan, the ECNY, started paying interest to verified wallet holders.
This is a fundamental break from global banking orthodoxy. We need to pause and explain why this is so radical.
Go for it.
For years, central bankers, the Fed, the ECB, have argued that if you create a central bank digital currency, a CBDC, it must act like digital cash.
Meaning it pays 0% interest, just like a dollar bill in your pocket.
Exactly, because if cash in my wallet paid interest, I wouldn't need a bank.
Right.
If the government creates a digital dollar that pays you 4 or 5% interest directly from the Fed, why would you keep your money in a commercial bank like Chase or Wells Fargo?
You wouldn't. You'd move it all to the central bank. It would cause a massive run on the commercial banks. The central bank would essentially eat the private banking sector.
So the unwritten rule was, digital currency is fine, but it has to be worse than a bank account.
But China just break that rule.
They shattered it. They reclassified the ECNY from M0, which is the economic term for cash, to M1, which counts as deposits. It now offers interest rates comparable to demand deposits.
Why take that risk? They have commercial banks too. Why risk destabilizing their own internal system?
They are betting that the internal risk is worth the external reward. Domestically, they are trying to claw back power from Alipay and WeChat Pay. But globally, and this is the key, they are trying to rival USD-pegged stablecoins.
Okay.
They're trying to make the yuan an attractive asset to hold, not just a payment rail.
This is the yield war.
It is. And meanwhile, look at the U.S. The sources mention President Trump's executive order banning a U.S. CBDC entirely and the CBDC Anti-Surveillance State Act. The U.S. policy is effectively government crypto is tyranny. But China is saying government crypto is a high-yield savings account.
There's a quote in the sources from Brian Armstrong, the CEO of Coinbase, that really stuck out to me regarding this. He said, China paying interest gives them a competitive advantage. He's basically asking, if the U.S. bans stablecoins from paying rewards, but China pays you to hold the yuan, where does the capital go?
That is the multi-trillion-dollar question. Capital is mercenary. It doesn't care about ideology. It flows where it is treated best. If I can hold a digital asset that is state-backed and pays yield versus a digital dollar that pays nothing and is legally gray, the friction to switch decreases significantly.
And we're already seeing the plumbing for that switch being built. The sources mentioned Enbridge.
Right. The Enbridge platform involved China, the UAE, Thailand, and others. It has reached $55 billion in transaction volume.
$55 billion isn't exactly pilot program money anymore.
No, it's production scale. That is $55 billion of cross-border value transfer that completely bypassed the U.S. dollar correspondent banking system. It's not a theory anymore. It's operational. The rails are built. Now they are adding the incentive, the yield, to use those rails.
That leads us right into the absolute mess happening in Washington. Because if the U.S. isn't building a CBDC, the private sector, the stablecoin issuers, are the only game in town for the dollar.
Right.
But the regulatory landscape described in these reports sounds like a battlefield. We have the Genius Act and the Clarity Act.
It is a conflict of visions. The Genius Act, which the sources imply has triggered significant momentum, regulates stablecoins. But the current fight, the real ugly one, is over the Clarity Act. This is where the industry is tearing itself apart.
I saw that Brian Armstrong withdrew support for Clarity. He called it a betrayal. That is strong language for a CEO who usually tries to play nice with regulators. What actually happened in the text of the bill?
It was the Senate revision. Originally, the bill was supposed to provide market structure, but the revision effectively bans stablecoin rewards for U.S. users.
So no interest on your digital dollars if you live in the U.S.?
Correct. Retail investors lose that 3 to 5% yield we've seen in the past. The banks lobbied hard for this, obviously, because they want your deposits, but it goes deeper. The bill also essentially bans tokenizing U.S. stocks on blockchains.
Wait, so the vision of me buying 0.01 shares of Apple on a blockchain, trading it 24/7, that's dead.
Under the current Clarity draft, yes. The sources describe a late-night betrayal that excluded real-world assets, or RWAs, from being defined as digital commodities.
Okay.
It forces them to be strict securities.
Explain the difference. Why does security versus commodity matter here?
If it's a security, it has to trade on a registered securities exchange, which have opening and closing bells. It breaks the current model of how they trade on crypto exchanges, which are 247 and global.
So you can't trade them on a DX?
You can't trade strict securities on a decentralized exchange under current laws, no. It essentially neuters the innovation of tokenization.
So let's play this out for the listener. What does this mean for the global map?
It means we are looking at a fragmented world. If this stands, you will have Asia offering interest-bearing CBDCs. You will have Europe and maybe Africa offering yield-bearing stablecoins because they have different regulations.
Right. Yep.
And the U.S. retail investor might be legally blocked from accessing either, stuck in a system where only the banks capture that value. It creates a yield wall around the U.S. consumer.
That is a grim picture for the retail guy. Land of the free, home of the 0% interest.
Pretty much.
But I want to pivot to something that might actually solve some of these efficiency problems, even if the laws are messy. Let's talk about the tech shift. The Neurons Lab and Natixis reports bring up agentic AI.
This is fascinating, and it's the third leg of our new era stool. We need to distinguish this from the AI everyone has used for the last few years.
Right. We all know chatbots. You ask a question, it writes a poem, it summarizes an email. It's passive. It waits for you.
Exactly. A chatbot waits for a prompt. An agent, or agentic AI, is active. It plans, reasons, and executes workflows.
So in finance,
this doesn't mean asking, how is my portfolio doing? It means telling an agent, rebalance my portfolio to minimize tax exposure and move 10% into low volatility yield. And the agent goes and does it. It executes trades, checks compliance, logs the tax data, and reports back.
the stats here are wild. 99% of financial firms plan to use these agents, but only 11% have actually deployed them. That is a massive gap between intent and execution. Why the hesitation?
Fear. Specifically, data governance and security. When you give an AI the keys to move money or access sensitive customer data, the risk profile changes completely. If a chatbot hallucinates, you get a weird sentence.
Right.
If an agentic AI hallucinates, you might accidentally liquidate a position or wire funds to the wrong account.
And the sources mention a dark side to this external to the firms, too. The security threat isn't just bugs, it's attacks.
Deepfakes. Deepfake scams in finance have risen 2,000%.
2,000%. That is absurd.
It's an arms race because agentic AI expands the attack surface. If an AI agent is verifying your identity for a bank, bad actors are using AI to trick that agent. They are creating synthetic identities, synthetic voices.
So the banks are using agents to catch fraud.
Yeah.
And the criminals are using agents to commit fraud.
Precisely. But the productivity boost is too big to ignore a prediction of a $3 trillion boost to the sector. Banks are using this for agentic banking, specifically for KYC, Know Your Customer.
How does that work in practice? Is it just faster?
It's transformative. Traditionally, if you trigger a money laundering alert, a human analyst has to sift through your last 1,000 transactions. It takes hours, sometimes days.
Right.
Now, an agent does it in seconds, identifies the pattern, and just presents the case for review. It reduces investigation time by 50%.
It's interesting how this ties back to the developing world. We have a source here about Flutterwave acquiring Mono in Africa, and they are using this tech not just to be cool or for efficiency, but to actually survive.
This is a crucial connection. While the West is debating the definition of a stablecoin in committee hearings, African markets are using them for basic survival.
Hmm.
The Flutterwave acquisition is about open banking and credit. In markets like Nigeria, credit scores, as we know them, FICO scores, don't really exist in the same way.
So how do they decide who to lend to? If you can't check a score, how do you know if I'm good for the money?
Data connectivity. That's what Mono does. It connects bank data to apps to build a financial portrait based on actual cash flow. But the so what here connects back to that AI fraud point.
Okay.
The sources mention African fintechs are deploying Liveness 2.0.
Liveness 2.0, is that a brand name or a technology?
It's a category of advanced biometric verification specifically designed to stop AI deepfakes. It checks if the face on the screen is actually a living human in real time.
Oh.
It's focusing on micro-expressions and blood flow detection that AI struggles to fake. Because stablecoins and digital finance are so prevalent there for trade due to currency scarcity, they have become the front line for testing these security tools.
That is ironic. The places with the least regulatory clarity are building the hardest defenses.
Necessity drives innovation. If your economy runs on digital rails because the physical currency is failing or scarce, you have to solve the deepfake problem before Wall Street does. They don't have the luxury of waiting for a Senate hearing.
Okay, let's zoom out. We have covered a lot of ground today. We have the death of the four-year cycle replaced by macroeconomics. We have China paying people to hold the yuan while the U.S. blocks yield.
Now we have AI agents starting a remote back office. It is a lot to synthesize. It feels like the map has been redrawn.
If you had to boil this down for the listener, what is the one thing they need to take away from this institutional era?
I think the key takeaway is divergence. For a long time, we assumed the whole world would adopt crypto in the same way. We thought it was one global open network. 2026 is proving that wrong. We're seeing three distinct financial operating systems emerging.
Break those down. What are the three systems?
You have the Chinese model, state-controlled, integrated, interest-bearing, and surveillance-heavy. You have the U.S. model, highly regulated, walling off retail from yield, but safe and institutionalized.
Okay.
And then you have the emerging market model, pragmatic, using stablecoins and AI tools for basic trade and survival, often bypassing the banking system entirely.
And the listener is stuck navigating between them.
Exactly. And the question is, which system wins? Or do they just drift further apart?
That brings me to the provocative thought I want to leave everyone with today. We talked about China paying interest. We talked about the U.S. banning rewards. If I am a global merchant or a sovereign wealth fund or just a regular person with a smartphone, why would I hold a digital dollar that pays me nothing when I could hold a digital yuan that pays me the same as a bank account?
It raises an incredibly uncomfortable question. Are we watching the technological unseating of the U.S. dollar, not by war, not by oil, but simply by user interface and yield?
If the dollar is the product just got outcompeted on features.
That is the risk no one in Washington seems to be pricing in.
Something to mull over as you check your portfolio. That is it for this deep dive. Stay curious, keep reading, and we will catch you on the next one.